Time in the market beats timing the market. You've heard this so many times. It feels like mathematical law, like gravity, like something so obviously true that questioning it marks you as financially unsophisticated. Stay invested. Don't try to time the market. The market always goes up over long periods. Time in the market is everything, and the data supports this, mostly. But there's a version of this advice that is specifically incomplete in ways that hurt the people who need good financial advice most and benefit the people who need it least. Because time in the market is genuinely excellent advice if you have the money to be in the market in the first place. If you have an emergency fund, that means a market decline doesn't force you to sell. If you have income stability, that means a recession doesn't eliminate your ability to keep investing. If you have financial cushion, that means short-term volatility is an abstract concept rather than a concrete threat to your ability to pay rent. For people with those things, time in the market is great advice. For people without them, time in the market is advice that ignores the specific conditions that make the advice work. And those conditions are exactly what separates the wealthy from everyone else. What the advice assumes without saying it. The time in the market principle is derived from historical market data. The data shows the S&P 500 has never failed to recover from any decline over sufficiently long time periods. A diversified investor who held through every crash in modern market history ended up ahead. This is true. The data is real. But the data analysis assumes something that gets left out of the advice. It assumes the investor never had to sell. In the academic analysis, the investor holds through every decline. They don't sell during the 2008 crisis. They don't sell during the 2002 crash. They don't sell during any of the corrections that happened between the starting point and today. The investor in the model is a robot. They experience no financial pressure, no job loss, no medical emergency, no family crisis that requires liquidating investments at exactly the wrong time. Real investors are not robots. Real investors lose jobs during recessions, which are the exact periods when markets are also declining. Real investors face medical expenses during market downturns. Real investors have family emergencies that require cash exactly when their portfolio is most depleted. The person who loses their job in 2008 has no emergency fund and has to sell index funds at the market bottom to pay rent, has not failed to practice time in the market. They were practicing time in the market. The conditions of their life made the strategy fail. The conditions that make time in the market work are not part of the advice. They're assumed, and they're exactly the conditions that wealth provides and poverty removes. The specific conditions that make the advice work. Let's name them explicitly because they're never named in the time in the market conversation. Emergency fund. 6 months of expenses and accessible cash that allows you to cover any disruption without touching investments. This means a job loss doesn't force portfolio liquidation. A medical event doesn't require selling at a market bottom. Income stability or income diversification. A single income source that could be eliminated during a recession makes portfolio holding during that recession contingent on not losing the income. Multiple income sources or significant savings reduce this vulnerability. No high interest debt. Carrying 20% credit card debt while investing in the market is mathematically irrational. The guaranteed cost of the debt exceeds the expected market return. Time in the market. Advice that ignores debt structure gives incomplete guidance. Sufficient margin between income and expenses. If your monthly income covers your monthly expenses with minimal surplus, any disruption creates a crisis that potentially forces portfolio liquidation regardless of how committed you are to staying invested. These four conditions are the infrastructure that makes time in the market work. Wealthy people have all four by definition. Their wealth provides the emergency fund. Their diversified income provides stability. Their savings rate creates margin. Their lack of high-interest consumer debt eliminates the mathematical conflict. For wealthy people, time in the market is excellent advice because the conditions that make it work are already present. For people without these conditions, time in the market advice is presented as universal when it's actually conditional on circumstances that most people hearing the advice don't have. The sequence of returns problem for regular people. Here's the mathematical reality that time in the market advice glosses over. The sequence of returns matters enormously for people who need to withdraw from their portfolios. The wealthy investor who loses 30% of their portfolio in a market crash and never needs to sell experiences a temporary paper loss that disappears when the market recovers. The regular investor who loses 30% of their portfolio in a market crash and then loses their job because job losses and market crashes are correlated, both happening in recessions, and needs to sell 20% of their remaining portfolio to survive the next 6 months, has a very different experience. They've sold at the bottom. When the market recovers, they have 30% less capital to benefit from the recovery. They've permanently impaired their portfolio's compounding capacity, not because they failed to practice time in the market, because time in the market advice, without the emergency infrastructure to support it, exposes people to a sequence of returns problem that wealthy investors don't face. Wealthy people can wait out any market cycle because their wealth provides the waiting capacity. Regular people often can't wait because life doesn't provide the pause button that the time in the market model assumes. Who repeats this advice, and why? Here's the uncomfortable observation. The people who most confidently repeat time in the market beats timing the market are almost always people for whom the advice has worked. They invested during their working years. They had stable employment. They had emergency funds. They never faced the specific intersection of portfolio decline and personal financial crisis that makes the advice fail. Their experience validated the advice, so they repeat it. To people whose circumstances are fundamentally different. The wealthy person who made it through 2008 by staying invested without selling because they had emergency funds, stable income, and no desperate need for liquidity tells the regular person to stay invested through the next crash. The advice is well-intentioned. The context is completely different. The regular person might not have the emergency fund, might not have income stability, might not have the financial margin that allows holding through extended volatility. For them, staying invested through a crash might not be possible. An advice that treats the wealthy person's experience as universally applicable misses the specific structural differences that make the advice work in one context and potentially harmful in another. The truth about what actually matters first. Here's the reordering that the time in the market advice skips. For someone without the conditions that make time in the market work, the priority is not getting into the market. The priority is building the conditions. Emergency fund first, not index funds. Emergency fund. The cushion that means market volatility doesn't create a personal financial crisis. High interest debt elimination, not index funds while carrying 20% debt. Debt elimination. The guaranteed return that exceeds market returns. Income stability improvement, not passive investing while dependent on a single fragile income source. Skill development, career advancement, or additional income streams that reduce vulnerability to the income disruption that forces portfolio liquidation at market lows. Only when these foundations exist does time in the market become the right advice. Not because the stock market is unreliable before then, because the personal financial conditions that allow you to actually stay in the market through its worst periods don't exist yet. The wealthy can go straight to time in the market because they already have the conditions. Everyone else should build the conditions first. The advice skips the sequencing because the people giving it already had the conditions when they started and don't remember having to build them. What actually works for people without wealth? The financial strategy that works is not different from time in the market in its destination. It's different in its sequencing. Build $1,000 in emergency savings before investing. This is the minimum buffer that prevents a single bad month from destroying investment discipline. Then capture any employer match in retirement accounts. Free money, non-negotiable. Then eliminate high-interest debt aggressively. The guaranteed return exceeds market returns. Then build the emergency fund to 3 months of expenses. Then invest systematically in low-cost index funds with the understanding that this works because you've built the conditions that allow you to actually stay invested. The destination is the same as what the wealthy would tell you. Be in the market for the long term. The path there is different because the starting conditions are different. Time in the market is the right long-term principle. It's the wrong first step for people who haven't built the infrastructure that makes staying in the market possible when things get hard. Time in the market beats timing the market. This is true. It's also advice that works unconditionally for people with emergency funds, income stability, no high-interest debt, and financial margin, which describes wealthy people. For people without these conditions, time in the market is advice that assumes a financial resilience that doesn't yet exist, and applying it without the supporting infrastructure creates the specific scenario the advice is supposed to prevent: forced selling at market lows during personal financial crises. The wealthy tell regular people to stay in the market because for the wealthy, staying in the market is always possible. For regular people, staying in the market is possible only when the right conditions exist. Build the conditions: emergency fund, high interest debt eliminated, income stability improved, financial margin created. Then get in the market and stay there. Because once the conditions exist, time in the market really does work exactly as advertised. The advice isn't wrong. It's just missing the part that applies to people who don't already have everything that makes it work. And that missing part is the most important part. For everyone, the advice was supposed to help most.